It's challenging for businesses to thrive in a constantly shifting commercial environment. The typical longevity of a firm is about 27 years, and the annual number of bankruptcies keeps rising. If there's no profit for your business, what can you do? How can losing businesses stay in business? In the cutthroat business world of today, every organization requires a strategy to remain relevant. This entails making investments in fresh goods and services to draw clients and encourage repeat business. No profit, no problem. Why do investors keep snapping up loss-making companies? Any firm that wants to develop must turn a profit. But some of the largest names in business today don't even have a profit. Publicly traded corporations such as the electric vehicle manufacturer Tesla and streaming music company SoundCloud incur losses in the billions. Similar to this, ride-hailing company Uber lost $4.5 billion in 2018. However, the company is preparing for a much-anticipated public offering that was expected to happen in 2019. Businesses that are not profitable do not deter investors. As a matter of fact, the percentage of American companies that announce losses prior to going public has reached its highest point since the dot-com boom of 2000. According to data provided by Jay Ritter, a professor at the University of Florida's Warrington College of Business, 76% of the companies that listed last year were not profitable the year before their initial public offerings. Though still much higher than the 4-decade average of 38%, it is less than the 81% reported in 2000. One reason why investors are prepared to invest in unprofitable companies is the IT sector's rapid expansion. Expansion is something that many shareholders cherish, and they usually feel more at ease when businesses aren't making enormous profits. According to Ritter's data, only 17% of tech companies that went public last year were profitable, while 43% of non-tech companies made a profit. That much is evident from the rise of the tech giant Amazon. Investors are eager to try out new company models. By market capitalization, Amazon is the second most valuable firm in the world, despite its relatively low profitability. With a net worth of more than $150 billion, this has made its founder, Jeff Bezos, the richest person in contemporary history. Although investors adore Amazon's stock, the company's overall earnings over the previous 20 years is insignificant when compared to other highly valued American corporations. Thomson Reuters data indicates that over the past 20 years, Amazon has produced less than $8 billion in earnings, compared to roughly $327 billion for Apple and $37 billion for Facebook over the same period. In fact, billionaire hedge fund manager David Einhorn began to wonder if the traditional investing ideas that guided his successful career really made sense in light of the market's frenzy for so-called growth companies. Last year, Einhorn mentioned his wagers against Tesla in an investment note, as well as Amazon, and stated that growth equities have continued to beat value stocks, making the market extremely tough for value investment strategies. What if a company's ability to be disruptive, to bring about social change, or to advance new beneficial technologies, even if doing so results in current and future economic loss, is what determines equity value, regardless of whether it is derived from current or future profits? However, there are also indications that the unrelenting pursuit of expansion at the expense of profit is beginning to slack off. The $1 billion funded Chinese bike-sharing startup Ofo said it was reducing its operations or leaving nations including Australia and India in order to concentrate on profitability. In the meanwhile, O'Reilly Alpha Tech Ventures' Indie.vc venture capital program prioritizes profitability when selecting which businesses to invest in. According to Indie.vc, it looks at startups that bleed black, a reference to profitable businesses. This is in contrast to many venture capital firms that prioritize growth and depend on a small number of successful exits. True companies produce goods and market them to get revenue. On its website, the company stated they prioritize customers' revenue and profitability over investors, valuations, and the next fundable milestone. We think that genuine businesses are excellent investments. For how long can unprofitable business continue? The world of business is dynamic and ever-evolving. One of the most important elements in determining whether a business succeeds or fails is its profitability. That is, its capacity to bring in enough money to pay for its outlays. Reaching this objective might not be as easy as it sounds, but most businesses can maintain profitability for a minimum of a year before they need to start making cost reductions or finding new revenue streams. The longer a business remains unprofitable, the less probable it is to make a profit. Studies have indicated that an unprofitable company can exist for an average of 8 to 10 years. An often overlooked trend in the global economy is the speed at which innovators are replacing manufacturers of goods, particularly technology corporations. Although disruption could seem like a bad thing for well-established businesses, it's actually a normal process. There are more new products on the market than ever before, demonstrating the constant state of innovation. Therefore, for established firms like Kodak or BlackBerry, the arrival of free or inexpensive replicas of current products on the market frequently signals their demise. A business may continue to remain unprofitable for an endless period of time, but ultimately its financial reserves will run out. This is typically the point at which client demand and income sources decline. In the end, this could be the result of outside variables like the recession or bad managerial choices like investing in the wrong market. Even in situations when sales are stagnant or sharply fall over time due to shifting consumer preferences, a corporation can nevertheless turn a profit through innovation. It's crucial to remember that businesses with established divisions could require financial support from their lucrative arm or arms to finance their loss-generating arm or arms. But in the end, they will fail as a whole if they don't reduce losses by investing less in the falling components. Why are non-profitable companies valuable? The one reason why unprofitable businesses are still valuable is because their clients are profitable. These businesses will turn a profit if they can figure out how to acquire new clients who are willing to pay the same price as their existing ones or convince their current customers to buy more. A business can only become lucrative through innovation. Many businesses conduct research and development or create new goods in an effort to boost revenues. Although these expenditures are not immediately profitable, they are essential for long-term performance, profitability. By utilizing knowledge about their market environment that others do not have, innovators generate a great return on investment. Put another way, an unsuccessful company will eventually be worth quite a bit if it focuses solely on innovation. Investors won't trust your viewpoint if you're a company with creative ideas and little revenue. This is because your ideas are unproven. Even if you may have a lot of potential, investors will stick with low-risk ventures if you can't persuade them of this. In actuality, corporate innovation is essential since many industries have not yet fully embraced technology. We've always been shameless about stealing great ideas, as Steve Jobs put it, sums it up the best. Therefore, the value of unsuccessful businesses derives from innovation that opens up future profitable revenue streams rather than from producing a ton of money for shareholders. Why can't so many lucrative startups succeed? With the advent of the internet and new technology, more businesses are becoming successful but not profitable. 70% of startups are predicted to become unprofitable 2 years after they are founded. Despite offering cutting-edge goods and services, these businesses eventually cease operations due to their inability to turn a profit. It begs the question, why? To begin with, startups bear greater risk than established organizations do since they lack historical data to guide their decisions. Additionally, when more large firms become accessible, they frequently lack the experience in their industry and the capital and resources needed to build their business rapidly. As a result, total revenue declines and costs rise at an accelerated rate. The tech innovation sector is growing rapidly and has experienced rapid expansion in the last few years. While some businesses have grown from small beginnings to large corporations, others continue to focus on specific markets. Though one cannot exist without the other, entrepreneurs frequently begin with the idea of where to create rather than how to profit. A business's ability to control its cash flow is essential to its ability to grow. People believe that all successful business owners have a strong sense of purpose and a desire to see their concept through to completion. But above all, they want their revenues to become profitable in the long run. Thus, the majority of these individuals are making money by taking advantage of market realities like saturation tendering or targeting certain niches. Innovative businesses can find great rewards and profitability from tapping into niche markets. But there are risks involved as well. No matter how tiny the niche may appear on the surface, there is possibility for growth if there are enough components of it that may be utilized. What do you think about businesses that aren't continuing to exist for a long time? Do let us know your thoughts in the comment section. For more interesting stories and updates, subscribe to our channel and do not forget to press the bell icon for notifications. Goodbye.